The Philippine economy grew at a slower pace in 2017, registering a full-year growth of 6.7%, according to the government data released on Tuesday. The country's gross domestic product expanded 6.9% in 2016. The Interagency Development Budget Coordinating Council targeted GDP growth rate of 6.5 to 7.5% last year. For the fourth quarter of last year, economic growth was 6.6%, similar to the same period in 2016, but lower than 7.0% recorded in the third quarter of 2017. During the last quarter, industry grew 7.3%, services 6.8%, and agriculture 2.4%. Socioeconomic Planning Secretary Ernesto Pernia, in a press conference, indicated that lower growth rate in 2017 was the trend in the post-election year.
Okay, before you heave a sigh of desperation or disappointment, let me give you some more comparisons with recent years, with recent election and post-election years in our recent economic history.
He noted that in 2005, a post-election year, the GDP was 4.8% from 6.7% in 2004, and in 2011, it was 3.7% from 7.6% a year ago.
And you can see that our decline is really very moderate at 2.2%, 2 percentage points of 1%, 0.2% of 1 percentage point. To me, this is a good performance given the fact that it's already normal for post-election years to witness a decline in economic growth.
Pernia said the country's GDP growing last year was still a strong finish that kept the Philippines' position as one of the fastest growing economies in Asia after China's 6.9% and Vietnam's 6.8%. For the fourth quarter, Pernia said the main driver of growth was public spending at 14.3% from 4.5% a year ago. He also cited that growth in exports of goods bounced back to 20.2% in the fourth quarter from 17.2% in the third quarter, offsetting the services export sector slowdown of 12.6% from the 19.9% in the previous quarter. He attributed the decline in the services exports particularly from the business process outsourcing.
We can take this as an indication that the current market profile of the BPO sector is ripe to move into higher value added services.
National Economic and Development Authority Undersecretary for Planning and Policy, Rosemaria Delon, said the growth in the BPO sector was usually very, very high. Up to now, its growth was still high, she said, but added that apparently it already reached its peak, thus the need to diversify into higher value added.
We have introduced some reforms in especially with respect to the higher level skills development, because that's what you need in order to move up the value chain. So you need the skills on big data analytics, skills for I guess AI, skills for more of the app development. So not the voice part of the PPO.
As to the effect of the newly passed tax reform measure, Pernia downplayed the long-term effect on the prices of oil and basic commodities.
I think the effect from the trend is going to be transitory. There's going to be a kick in the first few months or couple of quarters maybe, and then it will taper off, it will peter out later on.
President Rodrigo Duterte signed last December into law the Tax Reform for Acceleration and Inclusion Act, or TRAIN Act, increasing the value-added tax for certain products and services.
But in terms of the OPEC-induced price increases, that's harder to predict, but I don't think it will really be that significant. It will be, it will not be abrupt.
Pernia, also Director General of NEDA, said that for this year, the government would have a strong determination to accelerate growth to hit the target range of 7.0% to 8.0%. He said Build program would continue the momentum in providing more opportunities to the country, such as investments, job creation, connectivity, and dependable delivery of public services.
Certainly, the Philippine economy remains strong and there is still more room to grow. The government remains committed to making the growth inclusive.